Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Friday, April 10th, 2026, and we're seeing some notable market dynamics as traders navigate geopolitical tensions and prepare for key inflation data. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant theme right now is the interplay between geopolitical risk and energy markets. North Sea oil prices have hit record highs because Iran continues to maintain control over the Strait of Hormuz. And despite talks of a ceasefire, we're seeing US oil climb above $100 as tanker traffic through the strait remains restricted. This is creating a significant energy premium across markets. At the same time, we're seeing emerging market stocks positioned for their best weekly gain since 2020 ahead of Iran talks, which tells us investors are cautiously optimistic about de-escalation. The other major story is TSMC reporting a 35% jump in revenue to a new record high, driven by AI chip demand that's staying strong despite all the geopolitical noise. This is validating the AI infrastructure thesis that's been supporting tech valuations.
That's a significant divergence between energy concerns and tech strength. How are you reading the market's interpretation of these cross-currents?
Markets are essentially compartmentalizing risk right now. The energy spike is being treated as potentially temporary if diplomatic efforts succeed, which is why we're not seeing broader risk-off behavior. Instead, investors are rotating into sectors that benefit from either scenario. If tensions ease, emerging markets and global trade beneficiaries rally. If they persist, energy and defense continue their run. What's interesting is the resilience in tech, particularly semiconductors. TSMC's numbers show that AI infrastructure spending isn't slowing down, regardless of macro headwinds. Companies are treating AI investment as non-negotiable, which is keeping that sector supported. We're also seeing some concerning signals in credit markets, with reports of a narrowly averted redemption crisis at a Goldman Sachs private credit fund, suggesting there's stress building in less visible parts of the financial system.
How should traders be positioning given this environment?
Looking at the major indices, technically, the S&P 500 is holding above key support around 4,200, but we're seeing resistance at the 4,300 level. The index needs to clear that decisively to confirm the bullish continuation. The Nasdaq is showing relative strength, trading above 14,000, supported by the semiconductor strength we just discussed. The Dow is lagging, which makes sense given its heavier weighting toward traditional industrials and financials that are more sensitive to credit concerns and geopolitical risk. For traders, the strategy should focus on quality names with strong balance sheets and pricing power. In energy, the majors are obvious beneficiaries of sustained higher oil prices. In tech, focus on the infrastructure plays, the companies actually selling the picks and shovels for AI rather than chasing speculative AI applications. And watch credit spreads carefully, because if that Goldman situation is indicative of broader private credit stress, we could see volatility spike quickly.
Steve, let's get into the economic numbers. We've got important inflation data today. What's the picture looking like?
Thanks, Robert. We've had several important releases earlier this week that are shaping the economic narrative heading into today's CPI report. On Wednesday, we got GDP data that came in at 0.5%, which was below the forecast of 0.7% and significantly down from the previous reading of 4.4%. That's showing clear deceleration in economic growth. We also saw the PCE price index on Wednesday, which came in at 0.4%, matching both the forecast and the previous reading, suggesting inflation remains sticky at current levels. Initial jobless claims on Wednesday showed 219,000 new claims, which was above the forecast of 210,000 and up from 203,000 the previous week. That uptick in claims is worth monitoring as a potential early signal of labor market softening. Earlier in the week on Monday, durable goods orders provided some positive news, coming in at 1.4%, well above the forecast of 0.5% and matching the previous reading, indicating manufacturing demand is holding up better than expected. Now, turning to today's major release, we have the Consumer Price Index, which is a very high volatility indicator that measures changes in the price level of a basket of consumer goods and services. The CPI index forecast is 330.41, up from the previous reading of 326.79. This represents continued upward pressure on the overall price level, and it's going to be critical for Fed policy expectations. If we see CPI come in at or above forecast, it reinforces the narrative that inflation remains persistent and could delay any potential rate cuts. The Fed has been data dependent, and this CPI reading will heavily influence their thinking heading into the next FOMC meeting. Markets are going to react strongly to any deviation from that 330.41 forecast, particularly given we're already seeing growth slowing based on that GDP number from earlier this week.
Those inflation dynamics are certainly going to drive near-term volatility. Lizzie, let's shift to crypto. What are you seeing in digital assets heading into next week?
Bitcoin is showing solid bullish momentum right now, trading near $73,000. The sentiment is notably positive, supported by strong institutional flows. BlackRock's Bitcoin ETF just saw $269 million in inflows, its best day since early March, which signals renewed institutional interest. The macro backdrop is actually working in Bitcoin's favor right now, with recession risks rising and dollar weakness creating that classic alternative asset bid. Traders are targeting $80,000 as the next significant resistance level. There's also important technical work happening behind the scenes, with researchers demonstrating that Bitcoin can be made quantum safe without requiring a protocol upgrade, which addresses a long-term security concern. The risk factor to watch is that some older Bitcoin whales have sold $271 million in BTC recently, so there's distribution happening at these levels that could cap upside in the near term. Ethereum is also in a bullish posture, with a key valuation metric hitting levels we haven't seen since 2022. Traders expect ETH to hold above $1,800, and there's technical analysis suggesting a potential rally toward $2,500 if current support holds. Ethereum has been sliding somewhat alongside Bitcoin's struggle to break through 73,000, but the fundamental picture remains constructive. Solana is the outlier here with a bearish setup. Sol has entered what technicians call a consolidation trap below a key simple moving average, and there's risk of a drop to $52 if support breaks. Solana's price action has been weak, and it's underperforming both Bitcoin and Ethereum significantly. Overall, the crypto market is bifurcating between Bitcoin and Ethereum, showing institutional support and strength versus altcoins like Solana that are struggling to maintain momentum.
Well, that wraps up today's Morning Bell. We've covered a lot of ground from geopolitical energy dynamics to inflation data and crypto market trends. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell and join us again Monday morning. I'm Robert. Thanks for listening.